What?
You're up.
Well, it's Wednesday afternoon at 12 o'clock, and this is the Mortgage Firm, Wellington-LakeWorth, our weekly meeting with you, going over all your mortgage questions, your mortgage information, real estate, whatever it is, has to do with buying, selling, listing, refinancing, home, equity, line of credit, houses. The usual team is here. Michael Doyle is on the far side, who is with us today, and Elizabeth is in the middle here. We all know we've all worked together for many years at banking and mortgages and just this wonderful industry that we are in. In it. Today we're going to go over a little bit about interest rates, luckily, that have gone up and come down a little bit. We're also going to discuss HomeTown Hero Money. That's back for first-time buyers, which we'll discuss. And if we have time, I want to touch a little bit on alternative lending products that maybe, you don't, you're self-employed, you got to buy an investment property, other products that are available that aren't just the normal Fannie Mae, Freddie Mac agency type loans.
Yeah, and HomeTown Heroes is actually, I've been getting a lot of this question, like about being able to reserve now. And we really do need a contract in place to know exactly what we are reserving. It's not just a matter of, let me just go ahead and put, $20,000 aside just until I find a place. So make sure you get your applications in now. Let's make sure that your credit is where it needs to be. Keep in mind, there is criteria that you need to meet credit-wise, income-wise. So we do need to have an application in the system in order to know if you qualify for HomeTown Heroes or not.
Yeah, the HomeTown Heroes, Elizabeth is right. You have to have a property in order for us to reserve the funds for you. So we can't go in there and reserve the money if there's no subject property. I think that's why some of the funds are becoming available, because people might have reserved funds, but those deals didn't close or something might have happened. So the money comes back on the table. So yeah, when it comes to Heroes, we need to have everything together: income, approval, property, everything going.
Right.
I was going to go ahead and just pop in and look at the 10-year yield. So we could just.
It's a good day to do that. It's a good day to do that. It's unlike my crystal ball, which is usually wrong, as it was. We were at 5, I think, for just a couple of minutes, and then now it's just tapering down to luckily the mid 4s. Middle 4, 5. I think it was 4, 5, 6, or something like that today. So. Which is good for refinances. Keep in mind, all of you, including some of us on this call here, that have used credit cards for the last few months to get by, rates are coming down. So if you want to get rid of some of those high interest rate credit cards, might be a good time to consider refinancing.
Yeah, I actually just did a video on that this morning because
well, of course you did.
Of course I did. I'm gonna post it right after this. And then but interest rates, I was really shocked. I had somebody, pay off 4 credit cards and they were all 28-30% interest rates. I mean, I'd rather do an 8%. Do user equity in your home. That equity is up there right now. And then they were able to take some of that money, put it towards their house. They're building a pool. So you can't change the location of where your property is right now. You bought there for a reason. So might as well just make it your, just your perfect home now. Use that equity. And the other thing was also with the refinances, Tom, is paying off any investors that you probably had private lending with 10-15% on a loan. Take up that 8% rather than that 10 or 15% that's only going to interest only.
Yeah, a good look, if you're daunted by the interest rates of a mortgage right now at maybe 7 to 8%, just look at the back of your credit card statement. That's an interest rate that's probably in the late teens, early 20s. And I think they've even gone up even more. And my home equity line of credit has gone up. So yeah, these are things that you can get some equity out of your house and pay it on those high interest rate cards.
For sure.
Now tell me what you guys are seeing from your end. Are you seeing a whole mesh of screens, or are you seeing the 10-year yield at 4.5 right now?
Not the 10-year.
Okay, excellent. So you can see we've had a nice little drop. So we'll definitely take that little drop. And I'm looking at right now back through, we were back, let's see how far back we got to go to get this. We're somewhere right at September. So we're back at September's rate. So, we had a nice little, increase, and then we've come back down. Now we're expecting, a slow drop over 2 years, but this is what we're going to look at. We're going to see a lot of this. if we're going to do 4.5, we're going to see 4.6, 4.7, then we'll be down at 4.4, 4.3, then we're going to see 4.5, 4.6, 4.7 again. So it's not going to be a nice little steady drop, you know, and we could be looking at a couple months again where it slowly goes up. So we're going to be looking at a lot of bouncing around as it comes up and goes down. So we're still of the belief right now that we want a lot, you know, we want a lot. Because you can see right here, everybody thought at, you know, 4.2, hey, they're on their way back down. You know, right here, you're like, hey, they're on their way back down. Now here's our steady decline is getting ready to start. And then it doesn't. And then before you know it, we're up at 5. So, you know, it's moving in the right direction. You know, when we're seeing rates drop about 0.5 point, that's huge. But let's just get things locked.
Mm-hmm.
Yeah, once you find the property, you definitely want to lock the rate, even though we don't anticipate many more increases between now and the end of the year. You know, still looking into the first quarter and first half of next year. So be safe, lock in the rate once you get the property squared away.
Now, Elizabeth, you had an interesting one that we're looking at trying to convert. It was a condo that we need to do they're not going to pass a full review, and the customer doesn't have enough money to put 25% down. So you were looking at some other ways of making this work. What were you thinking?
So we were thinking of doing a first and second. So basically that second, the borrower would be coming up with 15% down, and then there would be a 10% second to make up that 25% in order to get that limited condo questionnaire passed. So we wouldn't have to show reserves. So the big thing was that this particular condominium did not have reserves. We thought they did at first. The contract came in, we were going to do 20% down, and then now we can't. Now we have to do 25%. So our option there is to try to do a second with 10%, and the borrower still coming in with 15% as opposed to 20%. So, and it's just the best case scenario for them.
I would say for the condos again, because the condos continue to be difficult. We had one actually just yesterday where we had an offer on the condo and the listing agent had checked that there is not a mandatory membership. And they were wrong. There is a mandatory membership. So the condominium was non-financeable from a conventional standpoint. Well, then we were switching out to alternative type of financing programs. And, you know, the nice thing is these alternative companies that can be more aggressive, they still couldn't do what we can do as far as counting income. So we can take retirement income for people that are 59 and a half, and we can annuitize that and create, we can take retirement accounts. We can annuitize those and create income. And some of the other investors that will do, you know, these condos that are difficult, they would not count income that way. So we were not able to do that. Now, luckily, the customer was able to come up with cash and get the loan done. But again, it comes back to these condos not being represented properly by the listing agent. And that's been part of our care recently is, you know, I am tired and just absolutely done with my customers dropping $2,000 on appraisals and inspections and questionnaires and interviews to find out that the information coming back to us a week before closing that we can't finance the condo, and it's because the stuff wasn't done up front by the sellers and the listing agent. All this stuff can be done up front. When a listing agent is talking to the seller, part of the cost of the carpet cleaning and maybe painting and all the stuff it takes to get your condo ready, now you have an additional cost of $350 for a condo questionnaire. And then that way you know if you can do full review, if you can do 25% down for a limited review, or whether you have to go with cash. But to go ahead and accept a 5% or 10% down offer on a customer, or it doesn't even matter, even a 20% down is a full review. But for you to accept an offer and you have no clue whether that condominium is financeable, and then for our customers to drop $2,000, I am so over that.
Yeah. And even on the insurance, I mean, there's some that we just need to look at that master insurance policy to know what their deductible is. I had one that we were seriously under contract just for one day, and we just had to pull out. I mean, we had to pull out of that just because we were able to have that master insurance policy. We saw that it was their 10% deductible. Borrower didn't lose anything. Versus another one that we had that we went ahead and did. You know, they had reserves, so it's no longer. Let me just check for reserves. Does it have reserves? And let me go ahead and do 5%. It's more than that. Customer was $2,000 in, like Mike said, between the inspection, the appraisal, the HOA fees, the condo questionnaire, because of course, like they all want their money up front. But then we get the engineering report, which they had at the very beginning, and borrowers out $2,000. So, you know, even the listing agents, I mean, this is stuff that listing agents should know ahead of time what's going on with you know, with that condominium. If you know, especially with your seller, we've said this before, you're going to look like a total rock star if you do your homework up front and you don't waste time. Not for the buyer, we don't want to waste time or money, but even for your seller doesn't want to waste any more time having this on the market. So, you know, just do your homework up front and get all the paperwork that that you need to get.
Distinguish yourself from your competitors. I mean, it's a way of really, when you walk in and you're on a listing appointment and you're saying, you let them know, we need to know if this is a cash buy. Do we need a limited review, or can we accept an aggressive offer with, you know, 10% down or 5%? I can do 3% down in some of these condominiums. But, you know, what can you accept on this? And you go in there and you're going to be the star, because the other people have no clue. The other agents have no clue about this stuff. We have agent after agent after agent on these condominiums that are no clue. The one I had yesterday was, I don't know. I said, can I finance? He goes, I don't know. I've only done cash in here. Do you have anything? Do you have a budget, balance sheet, master insurance? Have you collected anything? No, but you can probably call the HOA. I mean, no clue. So when you come in there and you understand condos, you give yourself your customers a great, so much a better opportunity, and you distinguish yourself from your competitors.
And the seller typically has access to a lot of these documents anyways, you know? So when you say, call the HOA, guess what the HOA is going to say? We need $500. We need $300. You need to go online and get this, get that. So all of a sudden you're not going to have, you know, you're going to be out money before you even do it. You're going to waste your seller's time. So just get that documentation up front.
And this isn't going away. It's not anything that's going to become any easier. So it's only something that's going to become more challenging. So the best thing to do is try to prevent the problem than try to solve a problem. And that's why we like to get the things up front.
And Tom, you mentioned also, you sent us an article about something else happened at another condominium lately. I think it was yesterday or something. So obviously when things like this happen in Boynton Beach, yes. When things like this happen, of course, this is all this happened for a reason. This didn't just out of one day somebody said, you know what, let's just make this harder. This obviously started when the Champlain Towers collapsed, and here we are with another situation. So we know it's not going to get any easier for condominiums.
Yeah, and a lot of condominiums that we know, or that we've been dealing with buyers have kicked the can down the road as far as any kind of improvements, because they don't want to affect their association fees. But right now that the state's coming down on a lot of that.
Yeah, I know we've said that. I've changed my thoughts on it. I mean, Champlain Towers was one condo on sugar sand built, with all kinds of problems, and then we've gone ahead and we've passed the problem on to every two-story condo everywhere in the state of Florida. But as it's unfolded, we have just seen these condos have absolutely, like Tom had said, have absolutely ignored all maintenance. So that they have maintenance they have not touched. They've had problems that they haven't touched, and it's really forced them to start addressing some of the issues. So that's a great comment. Kicking the can down the street just to the next generation or the next homeowners are like, I'll be dead in 10 years. Why do I want to be paying that extra $500 a month? We'll have somebody else work on the foundation. It's probably not going to collapse in the next 10 years. But we found multitudes of assessments and problems, and seeing a $500 a month increase in your monthly payment is not uncommon. So we do want to make sure that our customers are seeing this stuff. It's not a matter of like, oh, geez, the loan fell apart. Maybe another lender can do it. If your monthly payment's going up $500 a month or some unknown amount, maybe you don't want to buy the place. So, we want to make sure that we can finance the properties when the information is available to our customers and they're not misled. But we're not trying to finance properties with information that's been hidden from our customers.
Yeah, flip the situation around. If I was going to borrow, Elizabeth, I know it's just kind of like a drop in the bucket but a couple $100,000 from Elizabeth to purchase a building, I'm sure she'd want to be sure that not only am I going to pay back the loan, but the building is going to be there as well. There won't be any issues with it. So that's what government's doing. They're just wanting to be sure that the buildings are up to standards.
Mhm.
Yep. There's also something new that that we started doing this year. What is it? The CPM report? Is that what the certificate
Yeah.
from Fannie Mae? So now it's not just let me go ahead and run it through my condo desk to make sure that we are approving this. Now we got to get the certification from Fannie Mae to say yes, we could move forward and you could go ahead and close it now. So it's not just up to the lender to be able to say yes, we're going to go ahead and close. It's another extra day once we have everything in line to get that certificate back from Fannie Mae, to be able to close the loan. So it's gotten tougher, and again, it's just going to run smoother for both sides. The more information we have.
And again, as Elizabeth pointed out, this isn't any decisions that's made under the roof of the mortgage firm or any other individual lender. It's
Right.
all becoming more national, and a lot of government decisions are made long before we're even allowed to close on a condominium. So just like when the horse got out of when the lending institution kind of fell apart and computers started talking to everybody, and you no longer can have 5 primary residences.
Mhm.
Well, they're doing the same thing with condominiums.
Yeah. Yeah. The good days are over.
The party's over.
Again, though, what I do like to say is whenever you run into something like this that's difficult, it creates opportunities for those people that are more experienced. So, we look at there's a gigantic failure rate for condominiums, but I know that we can greatly increase the success on condos. But it does mean that we will have a higher failure rate than what we're used to. So it will appear to be very difficult. But as long as I see that we're closing at a much higher rate and we're getting the information up front, like I said, we basically denied ours in 48 hours. So it was before the customer, had started investing money in anything. But again, I just want to make sure we're not doing $2,000, deep for the customer.
Yeah, absolutely.
And usually when we find these things out about the associations or special assessments that maybe aren't brought up to the borrower at the time of contract or the buyer, once we find out about them, even though it does maybe, jeopardize the transaction or even kill the deal, they're happy that they found out before they ended up closing. So, if not, they might have been hit with a $400 or $500 a month assessment fee that they knew nothing about. It's not in writing anywhere, and no one's really obligated to say anything to anybody at the time of contract. So, I know we're digging and we're going down that rabbit hole, but we're doing it for a good reason.
Yeah.
Even the notes we need to ask for now in the condominium association meetings, and if there's any kind of indication or confirmation or conversation about any kind of repair, that's a red flag.
Yeah. I mean, I was surprised. I was asked for meeting minutes in 2022 for one. I'm sitting here going, 2022, and it was just because they needed the last. I think it was like 6 months, or was it enough for this year? And I'm like, how often are these people getting together? We had to go wait to 2022 to make sure that there was no conversation. So now, like Tom said, I've totally forgot about that. Even conversations are being monitored. Is there something that came up or was addressed that we need to look into? So.
Mm-hmm. Now we're going to be cutting out a little bit earlier, so I want to get to a couple questions here. But I got Kenny here is asking, would we recommend that he stays away from condominiums altogether? And I don't necessarily recommend that. Again, my big thing comes back to, again, long term. We want to make sure we're buying long term. So if it's a place you want to be, in a location you want to be, they can still be a great value. But just make sure you're getting the information that you need. So it's getting the information from the agents up front that you need, so there's not going to be surprises. Now, I really like it when they've already addressed their use and they've had the engineering report and the assessments have already been out there, so that you're not going to have the surprises. So yeah, I wouldn't stay away from condos, but I would be weary of ones that haven't started preparing.
Yeah, certainly still look for condos because they're a good price point, and especially for maybe first-time buyers getting into their first property. So not only are they, at the price range, for getting into your first house, but don't stop looking. Just be sure that we know the condominium you're looking to consider making an offer on in advance. Maybe we can get all that information up front, so you don't go through all the process and then finding out at the 11th hour.
The other thing is also just make sure that there are villas, there are townhouses that are listed as a townhouse, listed as a villa, and then we go into property appraisers and they're condos. So, just because it's listed a certain way, I had somebody say, "Oh, it's not a condo, it's a townhouse." Went straight into the property appraisers, and sure enough, it's a condo. So we
Mhm.
look right.
Yeah, we even have some single family houses that you look at a single family house standing by itself, but it's listed as a condo. Now,
Yeah.
I've got Erin asking also about insurance. She goes, I've been hearing insurance in houses at $12,000-$15,000. Is that accurate? Well, we are going through a lot with insurance, but a lot of times when you're hearing these horror stories of insurance, it's a company that doesn't want to do it. So they just don't want to insure, in the state of Florida. So they will say, sure, for $15,000, we'll insure your house. But we go ahead and we refer it over to reputable agencies, and they generally will come back with different quotes. A lot of it goes into Citizens too, and people have a negative idea on Citizens, but Citizens is, there for if your house, blows down or it burns down, and they'll be there to go ahead and fund you. The old days of insurance where you're supposed to bleach on a carpet and then you end up getting a new kitchen or something, those days are gone. You don't call your insurance agent when anything little happens because you don't want them to drop you. You just want them there to be there for the major stuff. So, and that's where we are.
Yeah, insurance we know is challenging in Florida, and so that's why we always say once you do find the property, let's start shopping for insurance right away.
All right. Now, guys, we've got to get out of here, so I just wanted to just thank everybody for showing up. We've got a class tonight for home buyers, so go to tmfclasses.com and register for that. And we'll see you every week. Also, go to our mortgage firm Firm-WellingtonLakeWorth Facebook page, and go ahead and join and follow us. And hopefully, we'll see you next week.
If you're seeing this on YouTube, like or smash, they say the like or subscribe button, so you're notified every Wednesday. So we'll see you next Wednesday.
Have a good week.
Thanks for joining.